Investors find opportunity and what's going on with bonds. Let's bring in Karniol-Tambour, Co-Chief Investment Officer of Sustainability at Bridgewater. It's great to see you again, Karen. There is this question about whether we've seen the bottom in rates and they are headed on a one-way ticket higher, which has caused a lot of angst for technology stocks lately. What's your view at Bridgewater as far as where bonds go?
Well, I'd say probably the most important thing for investors to think about is not the bond yield itself, but what the environment that the bond yield is showing is like. When you see periods when rates were rising, bond yields were rising, and that really was rates were rising led by the long end, and you get a steepening of the yield curve, that's really a sign that the economy is doing great and the bond market is getting ahead and the Fed is really behind what the economy is doing. That typically has been a great time to be earning risk premiums relative to when the bond yield is rising, reflecting that the Federal Reserve is trying to cut off the expansion, thinks there's too much froth in the market, too much inflation, trying to cut it off. Very clearly right now, bond yields are ahead of the move. And when that happens, it's a great time to earn risk premiums. You get this kind of fat yield curve and you get this incentive to keep moving into risky assets and looking at where there's risk premium left. And any rise in bond yields can kind of shake out some of the riskiest stuff in the market and kind of shake out the biggest froth, but can kind of give more fuel to let's give a little more time for the cycle to run. It's really a reflection things are good rather than a reflection that the Fed is trying to cut things off.
So it explains a lot of the recent action we've seen in the markets, the fact that value has outperformed. A lot of these cyclical groups like banks have really started perking up. Where does that leave us now, Karen? Where do you see the most opportunities given the backdrop you just laid out?
Well, I think it leaves investors in a spot where there's a desire to find where is there still risk premium to earn, and places where they're already looking pretty bubbly, there's already a big runoff, and there isn't a lot of risk premium to earn, are slowly being shaken out as the rates come up a little. And increasingly, it makes sense for investors to look out at places like, for example, emerging markets, diversification, or more value stocks, places where they still believe there's risk premium to be had.
Karen, to what extent do you think that U.S. Treasuries are being driven by the rate environment around the rest of the world? And is that only going to be a temporary factor, and thus could we be taken a little bit by surprise later in the year?
Well, the sign of the paradigm we're in really is that central banks all around the world have a lot of incentives lined up to lag the economy, to lag the recovery. So central banks sort of fall into two categories. Either they really haven't gotten a great recovery yet, for whatever reason, the vaccines are not coming through yet, or they haven't done a great job managing it, or they're like the U.S. and the economy is pretty clearly coming back, roaring back. But even in the cases where the economy is roaring back, all the incentives are lined up after a decade plus of very low inflation to basically say, let's let this go, let's lag the economy. And that's going to keep being probably the most important driver of markets, the fact that central banks are so wanting to lag the economy. And in some sense, the stars are aligned in that the Fed is, in one hand, facing the conditions that most classically would say maybe it's time to tighten, the economy is strengthening so quickly, but on the other hand, has been most vocal in saying we feel that our mandate this time around is going to be to let inflation rip until we know it's a problem, and to try to really get an inclusive recovery that deals with whatever shortfalls are available, whatever places are doing worse. And so when you look at the United States below the average and you take out kind of the most booming cities or the strongest job markets, you actually get a lot of places where there's still shortfalls. So all of the incentives are lined up for the United States, where the policy is the strongest, fiscal policy is very stimulative, to still lag the economy. And then other countries aren't even in a place where they'd want to. So that's a lot of central banks that want to stay behind the curve.
Shepard Smith here. Thanks for watching CNBC on YouTube.